newborn, I guess, but she hasn't slept since October. So
That's just 6 months. Yeah.
yeah, it's just 6 months of no sleep during probably the busiest season that I've had to deal with in a while.
Yeah. Not ideal. There's 6 of us on so far. Good morning, Bruce. Morning. Good to see you. Good to be seen. I have started the recording, so we've got that running. We've got about 6 on so far. Let's see. I don't know if you can see as people get in the waiting room, Robert. I'll keep trying to admit them as they come up. But if we start and they're continue to accumulate, okay. If you see them, let me know. Couple more here coming on. Just to confirm, Robert, you were doing slide 11, is that correct? I'm sorry? You're doing slide 11, or am I doing that one? I wanted to confirm. Slide 11. That's you. Okay, all right. Just confirming. Yeah. I had my order flipped. Yeah, and then you're 12. Got it. Yes, sir. So I'll be the segue there. All right, we got several more coming in here. A couple more minutes before we get started. Welcome everyone coming on. It is right at 12 o'clock. We've got about 50 in line. Maybe we'll wait another minute or two, see if a few more join, and then we'll get started here. Just another minute or so. Hope everyone is enjoying the beautiful weather. If you happen to be in the Atlanta area, it's another gorgeous day.
Kind of chilly out there.
It is.
Surprisingly, yeah.
Chilly. All right, we'll wait like one more minute and then we'll get started. We had about 25 RSVP, about 16 are on. I have some more folks still coming in. One more coming in. All right, well, it is 12:02, so I think in the interest of time, we'll go ahead and get started here. My name is Bruce Burkholder. I am a manager over at RESJ CPAs, SQ Smith and Jordan CPAs. We are a kind of a large local CPA firm based out of the Atlanta area with a few different offices around the Atlanta area, and do a lot of work in the 401k space. And so we're excited to have the privilege to talk to the group today. We have a great group, a mixed group of a lot of plan sponsors, some other plan auditors, brokers, TPAs, ERISA attorneys. We've got a great group, so we're excited to have some discussion here and present our webinar, and hope everyone finds it helpful and engaging, hopefully. At least that's the goal, as much as ERISA can be, right? So anyway, a few housekeeping things. I'm going to go ahead and mute everybody at the beginning here. Robert and I will do the presenting here. We do encourage questions. We've got some folks here in the room with me monitoring the chat, so you can chat in questions, and if it's appropriate to answer them in real time, Robert and I will, or if it makes sense to answer at the end, we'll do that as well. We'll come back to them. So we'll kind of approach the questions that way. If you had colleagues that had a last minute conflict arise or weren't able to join, we are recording, so you can just follow up with Robert and I to get the recording if you would like that. And we plan to finish well ahead of the top of the hour for those who have commitments at 1 o'clock. So with that, we're going to go ahead and get started. I'm going to go ahead and share the presentation here. Pull that up for us. All right. So you all should be seeing the presentation here. If you're not, let me know, but we've got it up here, and we're gonna go ahead and advance to our first slide for today. And I do have the privilege of co-presenting with the astute Robert Elder. So he's going to do a fuller introduction of himself here shortly, once I do just a quick overview, very quick, and then we're gonna jump into the first slide. But and I'll let him go into a little bit more of the objective here, kind of the learning objectives and how we want this to be helpful for the group. But some of the things we're going to cover, again, not in detail right now, but just where we're headed, planning for an efficient and effective audit, 401k plan audit, avoiding common compliance mishaps and misnomers, mistakes, misunderstandings, things like that we see working on these plans and around these plans. Understanding timely payroll remittance and remediating, a very kind of a hot topic more and more these days, it seems like. Process controls, which kind of are going to roll into the case studies question at the end. So with that, I'm going to turn it over, and we're going to go on to our first slide here. I'll turn it over to Robert.
Bruce, thank you so much. And everyone, thank you for joining us today. As Bruce said, my name is Robert Elder, and I'm an independent retirement plan broker and consultant in Atlanta. I've been consecutively working in the retirement plan industry for more than 26 years. right about half of that with McGriff Insurance Services. We have multiple locations across the country. I'm in the Atlanta office. Bruce's firm audits a few of my 401k plan sponsors that I'm privileged to serve. And stemming from one of those conversations recently about a mutual client, we got to talking about how it might be helpful for employers to have a discussion like this, particularly in advance of the audit season. So I do want to be clear that there's no strategic partnership here. There's no monetary connection between our firms or among any staff. We just want to reinforce some concepts and share some plan administration tips, because we're looking at the same data just through different lenses. So with that, let's get started with who really needs to pay attention to this. That would be any 401k or ERISA 403b that has more than 100 participants. Now, before you exit the webinar, because this doesn't apply to you, keep in mind that first, most of these administrative tips are going to apply to all plans, regardless of size. And second, you have two regulatory bodies, the IRS and the Department of Labor, both of which have purview over company-sponsored retirement plans and can audit a plan of any size for any reason. Retirement plans are subject to ERISA, the big body of law that oversees them. And if they are, they must file a 5500 tax return every year. There are two versions of the form. There's the long or large form and the short form. An independent audit conducted by an external accounting firm is required to accompany the 5500 filing if you're a large plan. Now, as usual, there's an exception to every rule. And what's called the 8120 participant rule, any plan that filed in the previous year as a small plan and still has under 120 participants can continue to file as a small plan and avoid the external 401k audit requirement. However, once that number of eligible plan participants exceeds 121 by the first day of the plan year, it's no longer subject to the 8120 rule and must be filed as a large plan requiring the external audit. Once the audit requirement's been triggered, that plan must continue to be audited every year until after the eligible participant number drops below 80. Now, the biggest confusion that I've experienced, which is understandable, is how the term participant, quote unquote, is defined. It's not just an employed individual with an account balance. The IRS defines a participant to also include terminated participants or beneficiaries with a balance, plus all eligible employees, even if they're not deferring compensation or have an account balance. So while your plan might not be subject to the external audit requirement now, as your business expands, the audit requirement might be introduced. One suggestion here is to review the number of terminated participants with an account balance is under 1,000, and if your plan is drafted accordingly, up to $5,000. With proper notice, you may escort those folks off your plan. There have been times that I personally have experienced where removing those balances has made the difference in staying below the audit threshold. And of course, there's also the possibility of drafting your plan on the front end such that you have a high hurdle, not essentially allowing some folks to be participants in the plan to start with. Bruce?
Yeah, sounds great. Yeah, and I'll say that is the most common issue we run into is just folks who aren't aware that, when we're doing these audits, we get desperate calls, folks who weren't aware that, folks who are eligible but choosing not to participate are still in that number. So that's something that we have to remind folks of and have those conversations that you really have to think about, not just balances in the plan, but those who are not contributing but could be. So that's something that we have to think about. And I apologize, I'm trying to just make sure that we've got the best view here of the slides. And if that's okay, is that okay, Robert? Is that visible?
Works for me, yes.
Okay. All right. And we can share the slides afterwards too, if that's helpful for folks. I think we're okay doing that. In case anyone's having trouble reading. So we're going to transition now to retirement plan audits and really the audit process and how plan sponsors can approach this, how we approach it from our side as the auditors, and really just what's the purpose? What are we doing? What are we testing? Because I know we have clients that we work with on these audits, and they just they want to know and understand more what we're doing. And so we try to educate them and help them understand the process. And so I want to kind of talk through some of those things now at a higher level of what exactly the key audit activities are. And we've highlighted ERISA here already, and really the financial accountability piece of the purpose of the audits. And participants are turning their money over to plan sponsors. They really do want the regulators in place, and they want to know that the financial accountability is there. So just speaking through kind of the key audit activities to kind of demystify it, if you will, for those who are, who want more understanding, and for those working around the plans, like Robert said, we're all involved in plans in some capacity here on the call. But really, when we start an audit, we start by reviewing the key documents. So we review the plan document, we review something called an SPD, a summary plan description. We review amendments to the plan, and all of those things to kind of just get a baseline of what kind of plan is this. That's particularly important for a first year audit, but things change, the environment is constantly changing. So review the documents, we look at amendments as well, and we really determine the accuracy of the information reported on the Form 5500 compared to the statements that we get from the custodian or the record keeper. And I wanted to take a second here and just kind of define some terms for the group, which are confusing for even probably Robert and I sometimes, and or those who work on plans. A lot of time you start talking and it can get a little confusing. So generally, you have the plan sponsor, who's the organization sponsoring the 401k plan. You have the plan administrator, who is a designated individual there at the plan sponsor, who's overseeing the plan. You have someone like Robert, who would be the broker, the advisor on the plan. You have plan auditors, like our team. You may or may not have a record. Well, you may or may not have a TPA, I should say, a third-party administrator. Some plan sponsors do and some don't. And it's really just how complicated is the plan, how comfortable is the plan sponsor, the plan administrator working with the plan. So there are third-party administrators. There's also the record keeper, which let's just call Fidelity the record keeper. Okay, there's the record keeper, which may or may not also be the trustee and the custodian of the assets. Lots of times it's one and the same, but not always. So when we're doing these audits, those are some of the activities we do, or get the statements from the record keeper, which is likely the trustee and the custodian, and we agree those out to what's available on a draft 5500. And ultimately, that's what we start working from when we're doing our audit. From there, we do things like assess the plan sponsors' electronic records. How are they securing things like that. We examine employee contributions to ensure timely remittance, and we'll get into that some more and what that means. There's a lot there. We confirm proper, accurate distributions and rollovers. We'll get into that some more towards the end, case studies, controls, when we get back there in the presentation. We also sample specific participant transactions, which really give us as the auditors the comfort we need on the completeness and accuracy of the plan and the remittances into the plan and the participant accounts at the end of the day, which is the goal of the audit, the financial accountability piece for the participants in the plan. We also interview those involved with the plan administrator, anyone who we consider a key employee to the plan. We interview them, ask questions. We try to do those inquiries early in the process because it's really helpful for us as the plan auditors working with the plan sponsors to identify really what's happened in the plan, what's gone on in the plan. We at times aren't able to make the inquiries until the very end, just because the personnel are busy and things like that. And sometimes things will come to our attention that no one else mentioned, the entire month we were working on the plan audit. So we really like to do those inquiries if we can sooner. But again, sometimes it happens more at the end. But that's an important part of what we do. So kind of transition there to some more practical things that hopefully all the plan sponsors on the call can relate to, and can take some things away from the information we've got here. So the 5,500 is due the 7th month after the plan year. So for most plans, it ends up being July 31st of the subsequent year if it's a 12/31 plan year. So we encourage plan sponsors start well in advance of that date if you can, in preparing for your plan on it. Now you can decide to do the 2.5 month extension, and the vast majority of the plans we work with do extend, just because the summer, lots of vacations, lots of people have time off at the plan sponsor, things like that, and just having that 2.5 extra months gives the plan sponsor extra time to get ready for the audit and things like that. There is no penalty or fee for doing it, but you do have to remember to file the 5558, which is just a form that says, hey, we're extending our 5,500 from July 31st to October 15th. If it happens to be a first year audit, again, Robert laid out all the kind of the criteria there, the discussions you're having if you think you may be in a first year audit type situation, and having that 121 participant count where you cross that threshold. There's definitely some due diligence we would recommend that you do. We've seen different things out there with different firms, and so just as a plan sponsor, again, plan ahead on it. But I would encourage plan sponsors on the call that may be thinking about an audit or or headed that direction, definitely just consider the knowledge of the retirement plan industry for the CPA firm you're interviewing. It really is important. It's such a highly regulated area, especially with late remittance and things like that, as we'll get into. Make sure that your prospective plan auditor CPA firm works with enough of these to know what they're doing. If they work with one or two, they may just be a dabbler that may give you a really good fee, but they may not actually know what they're doing. And if your plan gets audited, they'll get audited, and it could be a less than desirable situation. So if I have a heart problem, I go to a heart doctor. So if you need a 401k audit, go to a 401k audit. A firm that does enough of them know what they're doing. That's kind of a given, but just, are they service oriented? Do they want to educate? Does the firm you're talking to, they want to educate you on the plan, or do they just really want to kind of get in, get out, see you next year type thing? Because then we found that there's a lot of value that can be added to the audit process, just like what Robert does day in and day out as a broker advisor, as plan auditors. We feel like there's things we can help the plan sponsors we work with do better. Team-based approach is a big thing, and that reasonable fees given the size of your plan and the complexity and things like that. So those are some things. Hopefully those are helpful. May not be new for a lot of folks on the call, but they just want to kind of work through those as it relates to planning for an efficient audit. And we'll got one more slide here kind of on this area before we move forward to our next section. So if anybody has any questions, comments, feel free. You can chat them in, and we'll integrate them in as appropriate. We'll just keep moving ahead here. If you're a reoccurring plan, you may have used your plan auditor for 10 years. They may continue to be your best option, or you may want to consider someone else. Just depends. Do they continue to maintain the expertise to do the plan audits? Are they continuing to give you competitive fees and the service and things that you desire? So we just encourage, just evaluate that, every 2 or 3, maybe every 3 years, just evaluate if you're in the best spot you need to be there. I will say a big thing too is proactively schedule your audits and just execute an engagement letter sooner rather than later. It's interesting, we work on a lot of these audits, and it's kind of first our clients that it's a priority for, and we've got plenty of you guys on the call. We really we'll work through our audits. Some of our plan sponsors, 1st of May, they want their audit done, and then they can enjoy the rest of their year. And others, like to wait until October 1st. And so, that's really, I would say, up to the plan sponsor to dictate, how soon in the year they want to have the audit behind them. Some other things here, just helpful things that we found working with all of our clients that help us be more efficient and effective, and just work through the audits as quick as we can for our clients, is just, we'll provide a to-do list, we call it, really just a request list of what we need from our plan sponsors to get the work done, to get the work started. Really, we're talking about planning here more than anything. In these couple slides, as a plan sponsor, you can proactively work with the record keeper, the TPA, to ensure the audit package is ready for the auditors. Go ahead and get the 5500 draft and compliance testing, things like those, that's ready to go. That greatly helps the plan auditor get going and start working on the audit. Let's see, simple things, it's kind of goes without saying, but sometimes it takes us time as plan auditors, especially if we're working with a 1st-year client, to figure out if they prefer email or phone calls, or whatever their preferred means of communication. Scheduling the audit, to clarify this a little bit, I guess we probably meant more virtually or in person. Virtual and remote is kind of the same thing, I guess, but we've all gotten familiar with that the last 13 months or so. But again, if you have a preference, if it's really important for you to have your plan auditor there, then just communicate that, and hopefully they're asking that and you're not having to ask. They're saying, what is your preference? What's important to you for this? Confirming deliverables, timing, things like that, and just providing the information in a timely manner. I can say that the plan audits that go the smoothest, and the ones that are most challenging, it all really comes down to just certain things come up and you have to work through challenges with plan. Things happen, but just our plan sponsors that are really engaged and timely, we can work through their audits much quicker generally than those who are not. Status updates, things like that. I won't go into too much detail on these. So we're going to transition now. Checking on time here, we're doing well. I'm going to transition here to just some of the common stuff that we see go wrong with plans. Kind of talk through Robert and I's experience, clients we've worked with, and then we'll go into some more detail on some of the specific remediation issues, or just things to do to avoid, hopefully these things happening. By far, the most common, well, 1 and 2 are probably tied, but improper definition of compensation is one we see a lot, and it's really just, what does the plan document say about compensation? What are eligible wages to defer on? It's really not rocket science, but you actually have to pull out the plan document and read through it and walk through a participant and kind of understand how you're applying it. So we'll get into that some more. We have kind of our own, its own section in the presentation here. Late remittances, very common. Again, we'll get into more detail here for later in the presentation. Improper match calculations. There's more nuance to this one, but that is something that we do see. And so it's important to understand, again, what the plan document says about match calculations. How are you actually, what's the application of that in your plan? How are you doing that? And does it line up? Are you in compliance with your plan document? Insufficient bond coverage or no coverage. That's something we run into from time to time, more likely insufficient than no coverage. Participant eligibility and plan entry. This is a big issue, because if you have participants who become eligible at a month or 3 months or 6 months or a year, or at a certain age, and they're not allowed to enter the plan, you end up with remedial action. You have to do some remediation that can become quite expensive to you as the plan sponsor to make that whole to them on both the missed deferral opportunity, and also the lost earnings had they started deferring when they became eligible. So that's something that's very important. What does the plan document say? How are we monitoring? What controls do we have in place to make sure that we're on top of this? And when folks become eligible, we notify them, and they can either decline or they can elect in and things like that. Hardship distribution approvals. This is something we test on our audits, and it really, what we like to look at is we like to just understand the process at the plan sponsor, who's ultimately approving the hardship distributions, because there are very specific requirements relating to foreclosures, medical needs, stuff like that. So that's when we approach. So I encourage the plan sponsors that are tuned in to just kind of fine tune your process there. Make sure that who's responsible. Is it the TPA? Is it the plan administrator at the plan sponsor? Is it the plan provider? And just kind of sharpen that process and make sure that things are in order there to avoid, if the plan were ever to get looked at, making sure distributions were legitimate hardship distributions versus maybe something that should have been, a distribution that could have triggered a penalty, but it was treated as a hardship incorrectly. So there's some things there. Again, the loan approval process, that's kind of a similar thing that we can see as kind of a mishap sometimes. Is just really similar to distributions. Who's doing it? How's the process? Is it correct? Lack of proper controls, segregation of duties. That's something we'll get into some more towards the end, more in the case studies section towards the end. But that's something that we look at, and when we test around when we're doing our audit is, is there someone coming behind the payroll person, making sure that the contributions that are going to be withheld is actually, correct. And is what's processed through the payroll actually what ends up with the plan, sent to the plans. There are some things there. Lack of preparing and maintaining plan minutes for plan meetings. We've kind of seen that there's really two. We recommend always keeping minutes and having a committee, and we'll get into that some more in a little bit. But there's two types of plans that don't have minutes. One is a really simple plan, and they just may not be necessary. I mean, we would still recommend it, but if it's a very simple plan and it's a new plan that's still getting up and running, it doesn't have much history, very, very non-complex. The second situation is a plan that could be extremely complex, but they don't have good process and controls in place. They don't have a serious committee. They don't have regular committee meetings, and that generally is indicative of other issues going on in the plan that may require some remedial action, corrective action, things like that. So lack of minutes can be something that we would consider a mishap, or we wouldn't recommend. Again, playing right into that is just failure to hold any planned meetings during the year at all. We run into that some as well, and that's something that we'll make a formal recommendation to keep minutes and to have a meeting. So we're going to transition from there, and kind of naturally transitioning there anyway. Form an ERISA plan sponsor committee. Obviously, that's something Robert, would love to help you think through. What does that look like? Who should you have on it? How should you approach those individuals about the fiduciary requirements and things like that? So have a plan committee and ensure at least an annual meeting of the committee. There are times when more frequent may be appropriate. If you have a very complex plan with a lot going on, perhaps quarterly or twice a year would make sense. Or even just as things come up, you get the committee together to discuss. I know we saw a lot of that happening with COVID. We had some plan year ends that ended June 30 of 2020. So we were doing their plan audits, and they were a couple 2 to 3 months into COVID breaking out. So we saw a lot more resolutions, amendments, meetings of the committee and things like that. So I would encourage plan sponsors on the line so we hopefully are pivoting away from, COVID as it initially was, just for those first few months of 2020 and the pandemic, when things were very uncertain. Make sure that, you know, whatever was happening with the plan then was above board, and even you'll start hearing, as you have your plan auditors doing your 2020 audit here over the next few months between now and October 15th, they should be asking questions. If they're not, you may want to bring it to their attention, but hopefully they're asking and, you know, saying, you know, what did you do around CARES Act distributions, or what did you know, how did you document that you reduced your pay or suspended your match and things like that, and making sure that you know, you had those things documented. So take meeting minutes, we touched on that. Consider retaining a knowledgeable and trustworthy ERISA attorney. It's funny, of all the clients we audit, there are probably only a handful who do this. And it's great because when they have an issue come up, it's like they've already talked to the attorney about it, and they give us the memo and we do the audit, and it's you know, it's really it's great. And those that don't, you know, if they just hear attorney and think, oh my goodness, it's going to be expensive, you know, we don't want to talk to them. But we've got a couple of different ERISA attorneys that just, anytime we have a client that has an issue, they'll do a free 30-minute consultation, and it really puts the plan sponsor, again, depending on the situation, but it can put them at ease, or it can kind of help them realize, okay, this could be a serious thing. So I would encourage, you know, if you have a plan with any type of complexity, or even if you don't, you know, and again, we're happy, myself, Robert, happy to make introductions just so that you have someone that you can call. Because if you don't have someone that you know, or you don't have someone you can call, you know, you're probably less likely to just make a quick call. And then it kind of, you know, it may cause more issues later than if it had just, if there was someone that you felt comfortable calling. So we encourage that. Review the plan document and the summary plan description regularly. This kind of goes back to what we were talking about at the beginning. But you know, that's something that is really important to do. And I'm going to move through some of these quickly here so we can keep moving. Consider yearly touch points with auditors. Again, that's a great thing. Ensure proper understanding and execution of timely remittance. We're going to get into that some more. So I'm moving ahead here. Develop sound processing controls. Again, myself, Robert, we're happy to advise on these. We've kind of got the definition here. It's just, as a plan sponsor, our processes and controls in place to ensure that if something were to happen, is there a control there? Is someone reviewing the payroll file? You know, is someone maybe walking through the plan document once a year and just picking a participant to say, okay, we believe we're applying the definition of compensation correctly. And that moves us to the next slide here, interpreting and applying plan defined compensation. So as we've already determined, this is the most common error that we see. And you know, I think a lot of people just assume it's right, honestly, or we've seen situations where maybe an HR manager, or, you know, kind of the top person on a plan may come over from another plan sponsor and just assume that it was done a certain way, or they do it like it was done at their prior, you know, the prior plan sponsor they were at, and it's not correct. So that's something that we really, you know, this is, again, the points are right here, but just carefully review your plan document. You know, just walk through a person, just tie out every dollar of their compensation. Okay, we believe this is all eligible compensation. We understand they were contributing at 4% all year. Does the math work out? That's exactly what we do when we test them, and that's often how we identify the errors. Some things we see here, you know, are bonuses. Most of the time they would be if they're W-2 wages, but sometimes we see entire bonus runs missed just because you know, someone didn't read through the plan document thoroughly. Fringe benefits, things like that. Again, consider walking through a few of those. We're going to move now to the qualified non-elective contributions, which is a bit of a handful to say. Basically, if I could summarize this, it's basically when, again, right here, it's a missed deferral opportunity. Okay, it could be something like after 3 months, a participant becomes eligible, and there were no controls set up to identify that that person became eligible. And so they were not given the opportunity to contribute into the plan. And then a year later, it comes out, whether we identified in the audit or they just come asking about it, like, hey, no one talked to me about this. I haven't gotten any information. It can get very costly to remediate those issues. And the corrective action does depend on when it's found. Lots of times it's going to be the 50% because the errors can go a while before it's identified. And so you have to make the participant whole on a calculation of the employee missed deferrals. If you have a match in place, you have to make that whole, and you have to look at potential lost earnings on the on the deferrals had it been there. So it can become very, very costly, as you can see, especially if it's a group of people. Maybe you have you're building out a sales force and they get paid quarterly commissions, and they were never given the chance to defer on that those one-off 4 times a year commission pay runs, and it happens for a year or two, and they're large commissions. Things can happen, things like that. I would say it's more common just that participants just fall through the cracks. No one's really tracking when they become eligible. So, we're going to transition, and we do want to differentiate a missed deferral opportunity from late remittances. And so with that, we're going to transition to Robert. He's going to talk about really the other side of the coin, which is the money got into the plan, but was it timely?
Thank you, Bruce. First of all, with respect to payroll contributions, we're generally talking about employee deferrals. Unless it's stipulated in your plan document, employer matching or profit sharing contributions generally can be deposited up until the deadline of your employer's tax return, income tax return, including extensions. Second, the IRS and the DOL have different rules on payroll timelines. The IRS requirement is that payrolls must be uploaded to the record keeper no later than the 15th business day following the month of deferral. That can be considered the drop dead rule, if you will. The DOL rules, however, require that an employer deposit employee salary deferrals to the trust as soon as it can. Specifically, the agency has identified or elucidated a 7 business day safe harbor rule for plans fewer than 100 for plans with fewer than 100 participants, and a more aggressive but undefined rule for plans with more than 100 participants, generally 3 to 5 business days, but it's unstated. I've experienced instances where even the 7 business day rule was called into question by regulatory auditors because the employer had the means to upload the deferrals the same or very next day. So in sum, the standard should really be when you can. And as Bruce, I'm sure, can attest, payroll timeliness is a primary component of any independent or regulatory audit. If you have or suspect late payrolls, voluntarily correcting them now would be highly recommended, rather than rolling the dice and having a third party identify them. Finally, to mitigate delays or errors, we'd also suggest ensuring that you have a backup payroll processor when your lead staffer is, for example, on vacation or out unexpectedly. That's pretty common for a small business owner to have a single payroll representative. Also, plan for atypical payroll cycles, such as a holiday season or special bonus payments. And as Bruce shared, verify that the atypical compensation is actually eligible for deposit in the plan. Let's move on to process controls, both theoretical and practical. Next slide, please. So bear in mind that any individual at your company with discretionary authority over your plan's administration or investments is considered a fiduciary. The fiduciary standard of care is the highest known to law because those individuals are making decisions solely in the participants' and beneficiaries' best interests. The theoretical implications are pretty straightforward. Conscientious treatment of employees offering a diverse roster of investments, abiding by the plan terms, and so forth. What a fiduciary must not do is engage in transactions that involve a conflict of interest for them personally or for the employer, to use plan assets for their own interest or the employer's benefit, or to receive compensation from a party dealing with the plan. Now, those are pretty obvious, but two considerations that may be less apparent are the rules that an employer is not required to use the lowest cost anything, the lowest cost fund, the lowest cost advisor, auditor, or record keeper. There may actually be justification for utilizing a higher cost vehicle. So we wouldn't recommend that decision-making approach. Also, while most of the rules are pretty common sense, ERISA makes clear that corporate decisions must be made with the care, skill, prudence, and diligence that a person familiar with such matters should use. That's the operative language here. This has come to be known as the prudent expert and not the prudent person rule. In other words, it isn't enough to attempt to manage your plan properly. You have to act as a prudent expert would. If you don't have that expertise in-house, it's not just a good idea to use a third party, it's a requirement by ERISA. Now, moving on to the practical implications. Next slide, please. Allow me to spotlight just a few key items that I see as a broker and consultant. Now, while it might be unrealistic to verify all the numbers that your record keeper or TPA inputs for your 5500 filing, you can easily spot check a few things, particularly in Schedule H of the tax return. That's a location where you're asked if you had any late payrolls for the previous plan year. If you have, your record keeper or your TPA is going to have to populate Section 4A. Having any number in that space, no matter how small, can elevate your chances for a regulatory audit. Next, I've also discovered a lot of 5500s being filed with too little or no fidelity bond coverage at all. Fidelity bonds are requisite insurance requirements for sponsoring a plan. They're criminal bonds covering the unlikely but possible theft of employee payroll contributions. That's in Section 4E. There's even a question below that asks, did a plan have a loss, whether or not reimbursed by the plan's fidelity bond, that was caused by fraud or dishonesty? Now, I actually had a client a few years ago where the record keeper mistakenly answered yes to this question, and sure enough, they got audited. So very quickly, beneath that, items that are also important but not part of the tax filing. Be sure to be up to speed on employee notice fulfillment. Items such as a summary plan description, summary and report, and so forth. By that, I mean what must be provided, by when, and by whom. Unlike fidelity bonds, fiduciary liability insurance is optional, but may be worth considering. It covers fiduciary omissions and commissions pertaining to ERISA and is generally not part of your D&O or employee benefits liability insurance. Next, increasing consideration for cyber protection. That would be the internet connection between you and your record keeper, as well as participants' access to their data. In fact, the DOL came out just this month with cyber regulations and best practices. I will be sending out a summary of their announcement probably by the end of this week. Next, for participant-directed plans, it's important to publicly state your intent to comply with ERISA 404C on employee disclosures and communications. That provision generally allows fiduciaries to be relieved of liability for participants' investment decisions, provided the employee provides reasonable investment options and information. And finally, it's important to maintain a body of documentation evidencing your reasonable efforts to defray plan expenses. As Bruce mentioned, due diligence reviews and meeting minutes. Again, the lowest cost item is not necessarily the rule here, but it's important to have a body of documentation that shows you take this stuff seriously. So if there's one key takeaway that I can leave you with, it's that ERISA is more about process and than it is about product or outcome. Despite what you may read, hear, or feel, sponsoring a retirement plan, in my opinion, is a very manageable exercise and a very laudable enterprise. As long as you're sincerely employing knowledgeable individuals and making honorable decisions that are in the participants' best interest. Bruce?
Sounds good. Yeah, it's a great segue here to kind of the end of our presentation, and I'll take a few minutes here to just to talk through some positive and negative examples, and then we'll open it up for maybe a few minutes of Q&A if anyone has anything. Positive audit examples. We've been hitting on this the whole presentation, but it's really not overly complicated. It's, do you have strong oversight? Are there individuals in place, like Robert said? Are you hiring people who know what they're doing and who apply the necessary oversight? Along with that, good processes and controls. Clean and organized data is very important on the ERISA audits, because if you're not confident of someone's start date, how are you confident that they're let into the plan at the correct time, or that their planned compensation was correct, things like that. So the audits that we work with that are the smoothest, that are the most well-run, it really comes down to clean, organized data, training, a lot of training around processes and controls, because, again, it can be a little technical to understand the rules around timely remittance. But, if your team understands, okay, we need to do this as quick as we can. And if I'm not going to be able to do it that quickly, we need to have a plan together, a backup plan, or someone else who can remit the contributions on my behalf, while the person's out on vacation or something like that. Because as Robert said, if you're consistently remitting 3 or 4 business days, and you say, well, I'm, going out on vacation for 8 or 9 days, I'll just do it when I get back. When all of a sudden you've got one that's 12 or 13 days, that would come under scrutiny. For your plan auditors, they should, if they're doing their job, they should first of all be the one to flag something like that and ask about it. And they may, there may be a comment letter that they would issue, and you could get some documentation into your file to explain what happened. But again, things like that you need to be aware of. Negative audit examples, it really comes down to, really just a couple things. Misinterpretation of plan compensation. That can become expensive if folks were not able to contribute on compensation that they should have been, they were eligible to contribute on. Match calculations being incorrect. You have to think about the work to get compliance, could be a lot of legwork to calculate lost earnings with your broker, your TPA, or your plan provider. But then you've also got to actually make them whole as well. It's not just the professional fees to maybe do the work, but also making the participant whole there. Those are some of the things we see most commonly. We can go into some specific examples if it's helpful, but related to timely remittance, what Robert was talking about earlier, it really just comes down to do it as soon as you can, and there are some things to think about. If you have more complicated payroll and several different payrolls, it may be reasonable to take a few more days to gather all the data and remit it. If you've got a very simple plan, one payroll, very simple, there's no reason why 1 to 2 business days wouldn't be reasonable. So, it really just depends on, the plan and things, but the DOL really has provided that framework that we've outlined here. So that's really the end of what we had to discuss. So, I mentioned, if there are questions, comments, I know Robert and I had discussed a couple things to kind of talk through with the group that may be helpful, but please chat in if there are any questions, or feel free to speak up at the end here.
Bruce, if you could unmute everyone's lines, if you haven't already, and we welcome any questions that folks have either verbally or in the chat room. I had a question that I get from employers a good bit, and that is the opinions that you register there. As you know,
unmute all. You back with us, Robert?
Bruce, I'm here, and while we're waiting on any questions that can be asked verbally or via the chat line, I had a question for you about auditor opinions. And if you could maybe expound upon which types are registered, because I know that's part of the 5,500.
Yeah, I will do that. And I think folks can unmute themselves. I think I've got it set that way. So if you have a
Okay.
question, you cannot, please let us know. Nathan was kind enough to chat that in. So the question is the audit report for the plan statements. So the current opinion, generally, the vast majority of 401k plan audits are what we call a limited scope opinion. And the reason for that is we don't price test the investments. We're able to get a certification from a Fidelity or an Empower, really whoever the trustee and custodian is of the assets, that they're going to attest that they're accurate and complete for the year under audit, for the period under audit. So when we can get that certification of accuracy and completeness, we no longer have to do price testing. Occasionally there are full scope plan audits that require that, but generally we can rely on that certification. So our opinion reads under the current guidance that we are disclaiming an opinion simply because it's limited scope. And this is a helpful discussion, Robert, just because, we've worked through clients from start to finish and their plan's clean as a whistle, and we tell them that, and then we get their final draft of the report, and we'll get a phone call. Well, I thought you said everything looked good. You're disclaiming an opinion. And then we have this conversation of, well, that's simply because we didn't price test the assets. Your plan was clean. This is just the way the current opinion reads. Now, we are transitioning to a new opinion for the 401k plan statements that was going to take effect for plan years ending after December 15th of 2020, which effectively meant all 12/31 plan years audits, as we'll be working on over the next few months, would shift to this language that no longer disclaims an opinion. Now it adds a lot of other new things that may create their own challenges, but it won't disclaim an opinion anymore. That's been pushed back a year now due to COVID, so we've got another year that we'll be implementing that. But I know some plan sponsors read their financial statements closer than others, but for those of you who do read them closely and who pay attention to that, you will see the change there taking effect. Should be next year for your plans ending December 31, 2021.
Great. Thank you, Bruce.
I guess if I could ask you a question, Robert, if that's okay. You've got another minute or two. What do you recommend? So if a plan is, if they know that there's something lacking there with their committee, and they maybe don't have an agent of record, a broker, what's the most important thing? Like if you said, hey, you really need to start with these, couple things, what would you recommend?
Well, it goes back to that overriding principle of process. Do you have a thoughtful, prudent process in place? Do you have documentation for the decisions that you made in the past? I have parachuted in many times in the past as the broker, and although the plan may have been in existence for several years, there's no documentation. And so my first objective is to build a case file for myself and also for the plan sponsor, so they have everything, if not electronically, at least on paper at their fingertips, all the requisite legal documents, and then elucidate how the plan is drafted, particularly, as you mentioned, compensation. Do you understand what must be included versus excluded? So that's kind of first priority. Second priority is laying out a game plan. First and foremost, a due diligence, thoughtful process for building that case file, for building that body of evidence to demonstrate to any outside observer, we take this stuff seriously, and here's the documentation to prove it. Then the third, the kind of third thing I would say is employee education to fulfill that all important 404C requirement. Are you educating your staff? That doesn't mean you're providing investment advice, but are you providing a diverse roster of investments? Are you giving participants opportunities to get their questions answered and to reasonably educate them to make sound decisions? So that, and at a very high level, is how we get started.
Okay. Makes sense. It sounds like it comes down to documentation and trying to do the right thing.
Exactly.
Well, it is a few minutes to the top of the hour here, and I don't see any more questions. And I know folks have to hop off for 1 o'clock appointments and stuff. It'd be helpful, we could circulate the presentation. We'll have a recording available for those who may benefit from that. So please, reach out to myself or Robert or both, and we can get those things to you. We'll probably, we'll be back in touch on some of this stuff as needed. So we look forward to any follow-up. And again, thanks so much for joining. Robert, do you have any final words?
No, just I'm grateful for your time and for the team's efforts to make today happen. And we're certainly grateful for all of you attending today. I've spent my entire career in this industry because I fervently believe that despite the occasional administrative challenges, a company-sponsored retirement plan is the best vehicle that Uncle Sam gives us to save for retirement. So, and I've seen many individuals exit the workforce voluntarily and with dignity by availing themselves of it. So if you have any questions down the road, we are here to help.
Absolutely. All right, everyone, have a great rest of
everyone
day and weekend here soon. Bye.
All right, thank you very much.
Yep.